So let's look at why your pension over the last 3 years has delivered 0% and basically understand why fund managers underperform. What are the causes? What are the strategies you can use to improve your pension returns? That's what we're going to cover in this video. So we're going to look at some of the common causes of underperformance. That's important for you to know, whether you've got a workplace pension, whether you're in the UK, the US, America, or whatever else, or whether you've got an IFA or a wealth manager. Then we're going to look at what might be called structural and systemic issues, external factors, strategies for improvement is where we'll close off. So quite a lot to cover. Bear with me. Okay, so first of all, let's just introduce you to what all fund management is. And by the way, as a hedge fund manager in this field and formerly a barrister who used to look into pension fund underperformance, it's something which I've been involved in for 30 years. And I used to lecture on behavioural finance, i.e. why do fund managers underperform, at Oxford University as well. So I want to share all that knowledge, plus from my 200 columns in the Financial Times and my 18 odd books published by Macmillan, Financial Times and the like. So there's a ton of information and know-how I'm going to give you in this. Now, fund managers, of course, they're said to have a fiduciary duty. That is, they owe a duty of care to you. There is a problem with that. They have thousands of investors they've never ever spoken to. So if they've not spoken to them and they're giving a generic selection, then they're doing it based on what the objectives of the fund are. And the objectives of the fund are defined so broadly, because lawyers draft them and take it from a barrister, that they can't ever be done for that. So that raises quite a big problem, which is, okay, they've got all these duties which clearly are not to the individual's concern, they're to the objectives, and the objectives are so broad, they're meaningless. They've then got to make investment decisions. Okay, their job is, what do we buy? Now, here's where it also becomes problematic, and I've spoken to fund managers, I've spoken to board of directors of billion-dollar fund management companies, and this is where their investment decision, I'm not talking about the hedge fund industry, I'm talking about the retail investment trust, the kind of funds your IFA or wealth manager puts you in, and this is where it becomes, again, problematic. What they will tend to do is they'll look at the benchmark, let's say it's the FTSE 100, FTSE All Share, might be an ESG, might be a S&P 500, and they'll say, right, that's the benchmark we're trying to pick, that's what the holdings in the benchmark are, which ones do we increase, which ones do we decrease, so that we can try and beat the benchmark. Now, there's a problem with that approach, which you will have worked out, obviously, which is, wait a minute, why the hell are they looking at a benchmark? Well, because they're given a benchmark to look at. So they're not generating absolute returns. They're trying to just tweak a little bit above and below. They're taking quite a big gamble, because what they're saying is, oh, in the S&P 500, Apple is 6%. You know what? We don't think Apple will do so well, so let's make it 3% in ours. And they move those things around. Well, that's gambling. And not only that, they're not going for an absolute return. You might not want a whole load of poor companies in that index. You're going to get them because they're benchmark hugging. Eugene Fama got a Nobel Prize in economics for showing that. Regulatory requirements also mean there's a variety of regulatory requirements that fund managers have, one of which is they can't just hold cash and charge you fees for it, which means in a year like 2022 and once every 5 to 7 years when you should not be holding the asset class at all, they won't get you out of it. They will keep holding stocks because that's their objective. You're supposed to get out of it. Well, if you're going to manage it yourself anyway, then you might as well go the whole hog and not just give them any money at all. So the regulatory requirements can often tie a hand behind their back and see you lose, as in the case of Scottish Mortgage Investment Trust, 50% in just 1 year alone. So what are the types of investment trusts? Well, in the US, you'd call them mutual funds. In the UK, you'd call them investment trust. About 90% of those underperform their benchmarks, okay? Exchange traded funds, which I prefer, I've written about them in my Financial Times column for the first time. I wrote them about 25 years ago. ETFs, okay? These track indices. So there, you know what you're getting. You're getting the index, okay? And of course, hedge funds, the industry I come from, we charge 2% of assets under management, 20% of performance, not open to retail investors. So don't even ask. In fact, it's a criminal offense to promote them to retail investors. So I'm definitely not marketing and promoting alternative investments like hedge funds and private equity to a retail client, because you're not allowed into them. Why? Well, the long-only retail industry has lobbied the governments to ensure that they keep all the money. Basic principles of fund management. Well, they would say diversification. There's a problem again with this and why you're underperforming in your pension, which is this. If the markets go up and all boats rise in a rising tide, presumably you don't want diversification, because that means that you want some stocks which have fallen. Okay? Well, in a rising market, you certainly don't want it. In a falling market, the problem with diversification is there's a correlation to the downside. So when the markets fall, Microsoft and Costco both fall. The retailer and the AI company both fall. So when you need diversification the most, you're least likely to get it, right? This is something, again, I've written about in my books, not because I observed it or saw it. It's because I took the academic research and made it more popular. It's what I've lectured at Oxford University on my behavioral finance course as well, that this false notion of overconfidence through diversification, or we're diversified, we don't need to worry. Well, until you look at the data, okay? And these myths, these cliches come about, which are then used by IFAs to sell you products, but they haven't read the literature. What they've done is sat a multiple choice exam and become an IFA. Portfolio construction is the process of selecting assets for investment now and allocating your resources. Now, put in simple terms, if you want less volatility, you'd hold more cash. If you want less volatility, you'd hold more low volatility exchange traded funds with less than 5% volatility. Okay. And you would put money in between 20 to 40 stocks. After 40, it becomes pointless. And this is, again, something IFAs don't understand. Guess what fund managers do? Fund managers only give you one flavor. So you've now got to pick a whole bunch of funds. But what they also do is they spray and pray and probably have about 100 to 200 holdings. So even if they got a stock right, which did incredibly well, they'd have less than 1% in it. So that'd be a bit stupid. But it gives them enough material at the end of the month to write to you and say, well, Microsoft doubled in price and it's in our portfolio. Yeah, but they didn't tell you they've got 0.3% in it. I can buy every single stock in the universe and always be able to write to you every month and say, oh, this has done rather well. That's not the point. It's about how much you've got within it, and they get that wrong. Risk management becomes a problem because you can't go into cash by holding what they've got, and they can't go into cash. You'd have to sell them up, and nobody tells you when to sell out of a particular fund. And if you do want to work that out for yourself, then you might as well just manage the whole SIP and ISA yourself. Their own risk management is, we'll just put little bits of money in everything. Well, that's a pretty poor form of risk management, because what it's actually doing is ensuring you don't get good growth. And when the markets fall and everything drops, as I've already explained, in down markets, they lose 50%, as in the case of Scottish Mortgage Investment Trust. So that risk management actually isn't working. It's like buying insurance for something, but not realizing the insurance doesn't actually cover you. Okay, research and analysis, this is where they like to make out they're very clever. But there's another problem here, and Warren Buffett's identified this with fund managers. They go and meet the companies. They fly out to China and everywhere else, speak to the board of directors. Warren Buffett says he refuses to do that, and he's built $1 trillion business and is more successful than any fund manager, because he says, what are they ever going to tell me? Other than that, they're fantastic. So he'd rather look at the data and the numbers. And sadly, the problem with research and analysis with fund managers is they only look at a narrow group of companies, the ones that they've been allocated. So they've not been allocated all the stocks in the universe to then narrow down to the best 100. They've been allocated maybe just the FTSE 100 or 350 largest UK companies, and they've got to pick the best 100 out of that. So they're going to pick a third of those anyway. Ridiculous. Then you might as well just have an index tracker. Effective communication. Well, this is one of the biggest complaints people tell me they have with IFAs and wealth managers, that they don't communicate with them, they don't speak to them often enough. Weekly calls you could have, daily. What about twice weekly updates, as I give to my clients on Telegram? Aligning incentives. Well, there's a basic conflict of interest. The conflict of interest with the fund manager and the IFA and the wealth manager is this: they're paid as long as you own their product. So they've got to keep communicating to you, say, oh yeah, hold on to it, this is great, because they don't earn fees otherwise. They charge you fees of the assets you've given them. So they need to make sure they keep hold of those assets by making sure you're never too disappointed. The opportunity cost you suffer is 0% over 3 years, because they're trying to avoid you being too disappointed. Well, actually, you should be disappointed by the poor returns and the opportunity that you could have had when you consider that last year alone, the S&P 500 went up 25% and the NASDAQ 55. Where was your 55% return? Okay, so their incentives are not aligned to your growth, because they're not allowed to do performance-based returns. Even better than performance-based returns would be, they don't get either a percentage of your performance or your assets under management. Even better, they'll never do that. Nobody's ever done that. That's why I give people the data and let them select the stocks, manage them themselves, and say to them, you don't pay me. on assets under management or anything else. You make the decision with the data and the knowledge that initially used to be in all of these books and in my head as a fund manager, but now I want to transfer to you. So what are the common causes of underperformance? Well, of course, nothing's guaranteed. Even Warren Buffett doesn't have just one stock. But there's another problem, the emotional decision making. This is what I lectured on as a visiting fellow at Corpus Christi College, behavioral finance. The cognitive biases that fund managers exhibit in terms of overconfidence, in terms of confirmation bias, they want things which confirm their own views. I'll give you a classic example. There was an Asia fund by a major investment fund house. And it was over $1 billion which were in there, which isn't actually very big by fund management standards. And they called me in and they said, look, one of the things we're worried about is underperformance. And it's an Asia fund. And I was thinking, well, how the hell are you underperforming in Asia when it's been doing quite well? And they bought a whole load of Chinese companies and they hadn't done so well. And I said, well, you're an Asia fund. You haven't got any Indian companies, and India's where the money's been at. So then I looked at who the two fund managers were. They both happened to be Chinese. So there's a confirmation bias based upon the ethnicity of the fund managers, I suspect, that they were only buying things that they were most familiar with. I said, so where are they located? Singapore, and they fly out to China a lot. So they're not really interested in the Indian market, which is where the money was. And if you're an Asian fund, you really wanted to have more India over the last couple of years than you certainly did China, and their underperformance became quite clear. And worse than that, in a fund, on top of underperformance, you get a drop in the price compared to net asset value. So what had happened is if they liquidated everything, they would actually make for their investors more money than what the share price showed of the trading price of the fund. And the reason for that is because the market itself didn't have confidence in them. So they asked me, well, how would you go about removing that gap? Which happens. That doesn't happen in your portfolio. Your portfolio, if you're managing it yourself, is always marked to the market. That's another problem that people often don't realize. That happens when you're giving your money to an IFA and a fund manager, which is, again, why I've been on a campaign for people to use their SIPs and ISAs, i.e. manage it themselves more. Of course, then you've got fees and expenses. You add in the 1% and so the rest of it. The other problem with all of this is the cost of administrating a fund is why the fees would be such as they are. A consequence of this, which is bad news for you, the private investor, is that they'll get fund managers who are cheap to employ, okay? So that the asset management company which has set up the fund, let's say it was a Fidelity or whoever, gets to keep more of the profits from the fund and doesn't go to the two fund managers running it, who typically will probably be in their 20s very often, unless they've been around for a while, but usually in their 20s because it's a lot cheaper to hire them. And I've seen that done time and time again. Indeed, one of the people that a major fund hired was my secretary. She worked for me for 2 years, and then she was hired by a fund management company. Okay, cheap. She went from a secretarial salary to a fund management salary, which wouldn't be much more than her secretarial salary because it was the next job that she got. So there's a problem there as well. Now, behavioral biases, this is the area which I said I've written about, I've lectured on, and as a fund manager, I know quite a bit about. The behavioral biases that I've already mentioned, overconfidence, underperformance, blind spots, all lead to these problems. And there are ways of reducing these biases. It's just that your fund manager won't know what they are because they're never, ever educated or informed upon these things. That's why I lectured about it at Oxford to the students, so the next generation would know what these problems are. And Eugene Feynman, as I said, got a Nobel Prize in economics for pointing some of these out. So did Richard Thaler, and so did Daniel Kahneman in particular. All three of them, independently of each other, got Nobel Prizes in economics. And it was their work that I was lecturing on at Oxford, explaining why fund managers underperform. I was just repeating their work, which is why I won't get the Nobel Prize in economics. They did, because they were doing original work. I was just telling people this is what we should be looking at and learning from. Okay? So that's a major problem. Your IFA and wealth manager probably won't even have heard of cognitive biases, so forget that. Okay? Then there's the effective communication and transparency. They don't give you all the data. I give you all the data. I'll show you 10,000 equities. When I show my students, I say, here's 10,000 equities, and here's all the data on all of them. And I've marked in green the things which we know from the academic studies are important, and the white, the companies that don't meet that criteria. So they don't give you transparency, and they don't educate you or inform you ever. They just say, leave it to the experts. And the danger of that is that you've got no choice. You're handcuffed. Okay. And as for effective communication, well, you've seen all the newspaper reports on companies like St. James's Place that they don't communicate monthly as they should or regularly as they should at all. Okay. And that's a problem. So let's look at some of these structural systemic issues, some of which I've mentioned. They're constrained, of course, by the investment strategy. So now you've got a fund where you're thinking, well, I can't just put my money in this particular fund because they've got certain constraints. I've got to put it into that one, that one, that one, that one. So now you've got a hodgepodge of 10 things you don't actually want, none of which is ideal, thinking that 10 non-ideal things will give you one ideal thing. No, they won't. The ideal thing is to look at all 10,000 equities or exchange-traded funds and work out based on the data which ones suit you bespoke. Well, they won't do that for you. You know who will do that for you? $50 million and a Goldman Sachs private bank account. The wealth management division will do that for you. Okay. Short of that, you're left with this, which is basically the bog standard Lidl of private wealth management. Okay. It's, well, we'll just shove you in a box, charge you fees. Sorry. I think there's a halfway house, which is you're given the transparency of the data and empowered by the know-how. And I far prefer that approach. So like I said, you put it into a fund because you think this is limited by geography, by style, so growth funds in Vietnam, and you think, well, I've ticked that box. Well, no, because they're only looking at Vietnam and they're only looking at one metric, growth. Well, they're hardly going to find any companies because they've got such constraints. You actually want a fund which is allowed to look at 10,000 equities and then narrow it down bespoke to you. And only you are allowed to do that in your SIP and ISA. So again, those constraints imposed by the fund mandates are actually destructive to your growth in your pension. There's also, of course, I've mentioned inefficiencies in the industry. There's transaction costs when they're buying and selling. Now, you don't have the same inefficiencies. Because you're transacting such small amounts, you can go to a broker, which is next to free, to sell. They can't. They're going to get hit with big costs because they're trading in big sizes. They don't just sell Microsoft for you. They sell it in the hundreds of millions for everybody in their fund. Therefore, guess what? The broker's going to say, yeah, it's going to cost you this much. Limited transparency. Fund managers must work to improve transparency is absolutely key. They don't give transparency to you, and they won't necessarily have any extra transparency to what you can get. You can get all this data now that a fund manager has. They don't have something extra. They're not allowed to have something extra compared to what you have, because the Sarbanes-Oxley rule came out in 2008, I think it was, or 9, which said they're not allowed to give limited information to a few specialist fund managers or clients. Everybody must get the data at the same time. Okay, so that's a major problem as well. And of course, different funds have different rules by which they do things. So you think it's a ESG fund. Actually, they've shoved it all into a load of technology companies and claimed it's ESG. Okay, because they can label it the way they want. So you're not getting what you want unless you yourself are in a position with the data to select it. Over diversification, they spray and pray, and I've mentioned this, and so they lack the focus that you want for returns. Returns, as Warren Buffett or Bill Gates' portfolios show you, after their first 5 holdings, they've got less than 5% in the subsequent stocks. In other words, there is focus. There isn't diversification, there's concentration. As Warren Buffett says, put all your eggs in one basket, watch the basket. That's where the returns come from. And why would you concentrate so much? You'd concentrate because you want to make sure you're absolutely 100% satisfied with what you're holding. That's why you have that level of concentration. So let's look at some of the external factors which lead to poor performance. Well, as I said, regulation, adherence to those requirements. They've absolutely got to do it, and all of that increases costs, which means they've got to pass those costs on to you, so your fees go up as well. There's been increased competition from exchange-traded funds. That doesn't seem to have helped fund manager performance. Instead, you've still got a bunch of universities which are sending out 20-somethings, including my former secretary, to go and become fund managers because that's where the good money is. These are not people who are living the markets, okay? Instead, these are people for whom the market is just a living, and you're just the fodder to provide the money as well. One of the biggest tricks in fund management is, what's the key word out there at the moment? Oh, it's artificial intelligence. Right, create a fund, call it artificial intelligence, so we can raise the money. It is a marketing business to raise money into things which are the buzzwords. So create a crypto fund, create an AI fund. It is not meeting market demand. It is to meet the ability to get more capital and charge more fees and shove in any fund manager. It's a sausage factory of poor performance. If you don't believe me, well, why do so many of them underperform then? Data analytics, artificial intelligence, will it help them? They will use it as a marketing tool to say that they're getting better. Okay. One of the biggest problems for you, the private investor, is they've got more data than you have, but they don't need to have, because that data is now freely available thanks to the internet and general growth in retail investing. Okay, so you don't need to have that disadvantage that you would otherwise previously have had to handle things yourself. Okay, thankfully. So what are the strategies for improving? Well, as I have always advocated, get the data yourself, learn to do it yourself, which is where my advocacy for that has come into it. And learn what has to be done. Take a 12-month view, but it has to be DIY. There is no point throwing good money after bad and just giving it to the same people. Thankfully, it is easier now than ever to open a SIP or an ISA thanks to online investing. It is easier now than ever to stay up to date with your portfolio because it's on your phone, and we're more used to using these things. I couldn't have said this 10, 20 years ago. Technology, thankfully, has caught up, which has made things like my campaign for $1 million and my great investments program feasible and viable now. I'd also say reduce your cost by you doing it yourself, remove the middleman, which is how we always remove costs, and align the incentives for a return. Who cares more about your money than you? Remove the people who've got conflicts of interest and you take control of your money. It's your money. You wouldn't do this with anything else and just outsource it constantly to people who continue delivering poor performance. So in conclusion, implement those effective strategies, i.e. you learn how to do it. That will give you the opportunity to generate higher returns. At least you'll get the transparency and remove those causes of underperformance, such as spray and pray fund managers, IFAs who haven't got a clue on what they're doing. Have a look at alpeshpatel.com/links if you want me to have a look at your portfolio, to give you a second opinion, give you some information, education on it. Not advice, but information, education. If you've got over 100K, have a look at alpeshpatel.com/links. But also, if you want to look at my campaign for $1million.com and you want to have the data and so on, well, do have a look at that and get in touch as well. Thank you very much.